Hey, and welcome to Tax Tuesday with the Tax Queen. I am Heather Ryan, the owner of Tax Queen, and I'm here to answer your questions. I do this monthly Tax Tuesday to help digital nomads, RVers, remote entrepreneurs, right, with tax questions. So that's what I'm here for. If you are live, I would love it. Just put in the chat where you're listening from. I know we're kind of all over the country, possibly the world. I do serve clients everywhere. So yeah, if you see me looking to the side, I do have the questions pulled up. So this format kind of people can submit questions ahead of time, and I always go through those first, and then I will take some live questions as we have some time. It is the thick of tax season, so I probably will try to limit this to half an hour at the most. But I do have a few questions to go through, so I'm going to go ahead and get started. But again, if you're here live, just let me know you can hear me and see me, and just leave a message in the chat of where you are currently. I'd love to kind of know. Sometimes that's fun to see where everyone is. So, yeah. Okay. So first question, I received a 1099 that includes a payment for an invoice issued or that the issuer paid on 12/31, but I didn't get the check in hand in the bank until January. That means I'm reporting in 2024 less income because I am a cash basis. In addition to this, they included a payment made to me in November that got lost in the mail, and they have had to reissue the check, which I still haven't seen. How is this handled? Um, so when you're cash basis or cash um, reporting your business, you report the income that you earned in that year. So anything you physically deposited, whether that's actual check in hand, right, such as this person, or whether that's a like an ACH or some other kind of payment. Um, yeah, so in this case, I don't really care what the 1099 says, right? So this problem here is that they're saying the 1099 was issued for more than, well, I actually don't know. They're saying maybe it's issued for more than they actually received in 2024. And for the most part, I kind of ignore 1099s as the receiver, right? And for the business owner, you need to report all of your income. Okay. Normally, when I see this, it'll be greater than any 1099 that's issued. So it's not really an issue, right? It's not a problem. As long as your income is greater than the 1099s that are issued to you, greater to or equal, right? If it's the matches, that's fine. Then it doesn't matter. So they're going to match up, they're going to be higher, or it's going to be equal to, and it's not an issue. So in that case, you are a cash basis, so you report what you receive. If the money wasn't received, literally not received until 2025, then that's when you report it. In this case, that business might be on an accrual basis and be able to take those deductions because that work has already occurred, even though the money hasn't been cashed, right? So they actually may be in the right as far as their 1099 issuing. So that's kind of how I would work it. If this were my client, I would work with you if the numbers weren't matching up to kind of review that. But generally, you don't need a corrected one as long as your income reported is greater to or equal the 1099 total. So if you have several, right, as long as you're reporting higher. I hope that explains that a little bit. A lot of people consider like the 1099 NEC or the 1099 miscellaneous, like that's their bookkeeping, and I highly discourage that, right? You should be tracking your business income on your own, and especially if you have multiple sources, and it should always be equal to or greater than the 1099s that you receive. Okay. Um, I'm going to move on to the next question. So I'm a nomad, but I have a rental property in California. I also have Social Security, pension, distributions that are pre-taxed. Since I've been out of the country for over a year and want to continue traveling, what do I use as an address when I file? I do not want to use my rental property because I do not live there. Okay, so this isn't really a tax question, but I'm going to answer it because I'm here for my digital nomads and my RVers. When you leave full time for traveling, um, you need an address, right? So normally we'd have a driver's license if we have vehicles, right? We have them registered somewhere, registered to vote in some state. And in this case, you have a rental property in California. So if you didn't change what we call our domicile address to a different state before you left the country, because this person is traveling outside of the United States, then you are still tied to California. And that is a big thing. So domicile is a legal issue, but it kind of moves over into the tax side of things, right? As we don't cut ties with a state with state income tax. So that's really step number one is cutting ties with a state and moving, right? So moving is having a mail service or mailing address that you can use that is not in that state. That can be a family member, a friend, you can use mail services. That's my recommendation. So those are kind of your options. And in this case, moving to, like Texas before you leave the United States for your travel internationally, and especially those who are RVers, moving that domicile to a tax-free state. That's the first thing you do before you leave the country or before you start your journey on full-time traveling. So yeah, that's kind of um, yeah. I also wrote a article about this and I can share it here, kind of how to choose your domicile. That's really kind of answering that question. Again, this is more of a legal thing than a tax thing. So, just so you know, on your tax return, the address that you're putting on there is actually just a mailing address. So it doesn't have to match necessarily like where you physically are or like what and I have people that move, right? So their new address is going to be reported on there. That's the latest thing, even if they were a part-year resident, let's say in California. But now they moved to Texas, so their Texas address is going to show on that tax return. So, all right. We are not full-time, split our RV usage between personal and business use as a meeting space for clients. We bought our first RV in 2020 and have been appreciating it through November of 23. We then bought a different RV in 23, which we started using and depreciating as of November. We sold the first RV in July of 24, and we know that we need to recapture the depreciation as we depreciated more than the value decline during that time. So this is getting into the kind of the weeds here. I'm not going to keep reading through the whole thing, but the thick of it is, yeah. So when you have something that you depreciated, depreciable assets like an RV, right? So we're taking it over time. Um, you do have to recapture it if you either sell it or stop business use. The business use drops below 50%. You can recapture it. Recapturing depreciation is just considered taxable income. And in this case, this person is thinking that it should go on their Schedule C, and that is incorrect. So it's selling of an asset, right? So it doesn't go on a business. In this case, a Schedule C, a sole proprietor. It does go just on the 1040. And it's specifically the form 4797, and that's reporting the sale of assets. So in that case, this kind of complicated, and I would really work with this person. They're asking about TurboTax. I don't use TurboTax. I'm not familiar with TurboTax. I cannot give guidance on it. So I just work with my clients to help them through stuff like this and to compute these values. So that's kind of, I can't really give a specific answer other than yes, you have to, recapture that depreciation and no, it's not on the Schedule C. So all right. So question number 4. My husband took the week-long RV tech class last May in 2024 in anticipation of following up with a certified inspector course later this year in 25. He has a couple of small repair jobs in 24, so he made a little bit of money. That's awesome. He set up his business, sole proprietor. Is the cost of training and accompanying trip to do this new certified inspector course a business expense? So there's a couple there's a couple things here, right? So education, if we change careers, education is not a deductible expense. If you already are in an industry, getting a license, getting a certification, getting more education, so taking more courses, learning more things can be training and education. But the initial education, right, as we change careers into something and we go into a week-long tech class, right, that first class would not be deductible. If we're already working in it, so now in 24, right? So we have this business and we're already in it, and now we're going for further education related to that career and to that business. Now we can deduct it. So it is considered training and education for further education. So you would just take that on your Schedule C for the sole proprietor business. So yes, education can be, but it can't be considered if you're switching careers. So just be really careful of that. I actually work with a lot of RV techs, people that go and get another education out of changing careers at whatever stage in life they're in. And that initial education is not deductible, right? Because we're switching careers. And once that taxpayer is making money in that new career, now that certification is allowed. Okay. Or it's allowed as a business expense. Okay. I got a couple more questions and then I can move to some things um, live. I do see some questions. I see someone here from California. Awesome. Anyone else? So let's see. So my wife and I own 3 RV rental sites. We also own a motor coach and house. If we travel between these sites, can we write off expenses related to the motorhome? Um, so travel is allowed to check on rental properties. Um, this one's a difficult. It's kind of a the motorhome is not 100% used for business, right? So it's also personal. I mean, travel is allowed. So normally what we consider travel is a flight, hotels, or like we're duplicating our living expenses. In this case, you have an RV and a house. So you kind of are, I guess, duplicating. And I would say, yeah, you could probably take your mileage. So track your mileage. Be very cautious here. Have a really good mileage log. Um, and yeah, because travel expenses are allowed, and that is taken on your rental forms on your 1040. So I would just be really cautious here, and not to take all of your RV mileage. It's just a red flag. Mileage is a red flag. So just being aware of that, and don't just uh, like take this roundabout route to get to your one property and stop along the way. Like it's a very gray area. So I'd be really cautious there. So accounting needed, yeah, recording all your expenses, having that mileage log is really, 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 really important. I always stress keeping a separate bank account. So even for rental properties, keeping a separate bank account you use for the income for the property and for all the expenses. And this is for several reasons, and that you're not going to miss any expenses, right? Everything should go through that one account and never touch your personal money. And it just keeps things easier. So that I hope that answers that question. That one's kind of it's a very gray area with RVs and being able to deduct them. But I think mileage should be allowed. I would just be cautious if you're doing some personal stuff along the way. So, all right. I am trying to determine auto expenses. Can you tell me which is better, the standard mileage rate or taking actual? So this is a loaded question. I get this a lot actually. So auto expenses there are 2 ways to take auto expenses. And this person is asking about which one's better. And so the standard mileage is just the rate that the IRS gives every year, and it changes. In 2024, we're at 67 cents a mile, and that's just the standard rate. So if you drive 100 miles, right, multiply that times 67, and that's your deduction. Nobody usually just drives 100 miles, but we'll give it as an example. If you're taking actual expenses, you need to have the mileage log, which we need, right, if we're taking the standard mileage, but we need it for both. So actual expenses are oil changes, maintenance, registration, licensing, any kind of repairs, anything related, insurance, right? Anything related to that vehicle. And we get to take it as a percentage of business use. So if we drive 10,000 miles in a year and 5,000 are for business, right? So 50% business use. So we get to take 50% of all of those expenses for auto. Um, and it does get, for the most part, I see the standard mileage deduction the best way, the easiest way. You do need the mileage log. Um, and it usually adds up for more. It's usually easier. It's like less bookkeeping, less hassle, record keeping, all of that stuff. We just need the mileage log. We don't need to worry about all the other expenses. But generally speaking, I see it better. Of course, there's cases where taking actual expenses might be better. And I just work with my clients on a one-to-one basis to know which one is better for them. And sometimes I don't like to look at it as just 1 year. So like, oh, let's just look at 24. No, let's look at the life of that vehicle. So let's look at 24, let's consider 25. Are we keeping that vehicle into 26 or maybe even 27, right? Some people keep them 5, 10 years. So just thinking through that, not just this year, but planning for the future. And the other thing is if you take actual expenses the first year you put a vehicle into use for a business, you must always take actual expenses. So keep that in mind. That is one catch. Sometimes people think, oh, I had a really expensive year. My car needed all these repairs. Let's take actual expenses. Well, now you always have to take them. So keep that in mind. So I did share a little article too. I wrote about taking mileage and auto expenses. So if you want to learn a little bit more about that, then go ahead and read that article. And that's all the questions that I got previous to today, so submitted ahead of time. I do see a few here that were submitted live, and I thank you for those. So let's go back and read through them. The first question is, are there potential deductions for an independent contractor that does their work abroad? I'm not really sure. Um, Specifically what you mean there. Anyone who's running a business, because a contractor, a 1099 contractor, right, is running a business, first of all. And whatever is needed to do that work is what you can always take. It doesn't change if you're wherever you're living. It doesn't matter. You take business expenses related to that business, anything you need to do that work. So I hope that answers that question. It's kind of a broad question. But yeah, potential deductions for anything. You're looking at software, you're looking at a phone or internet services. Do you need specific equipment? Do you need like a camera or computer? Um, do you have insurance, like liability insurance? Are you using a lawyer for services, writing contracts? All of those things, right? Ordinary expenses for running that business. And I think that's one of the misconceptions I hear. Oh, I'm a contract worker. You're not a contract worker. You're a business owner, right? 1099 business owner. You're receiving money for doing work, for doing services. So hope that sort of clarifies that. And then the other question is the BOI not required anymore. So BOI is the beneficial ownership information report. This is not, and I will repeat, this is not tax related. It is finance related, but not tax related. And just this week, they did issue guidance that they are suspending. They're not going to enforce it. So it's not disappeared, but the whole point of this report, it goes to the financial crime network. That's who we're reporting it to, nothing to do with taxes. Um, but they did suspend it and they're trying to basically change it so that it's for foreign owners, right? That's what they're trying to catch. They're trying to catch foreign owners. So yeah, not tax related, but I'm still happy to try to answer questions. Can the gain from the sale of a home be offset by the purchase of a motorhome? Absolutely not. So there's a couple things there. If you have a home and it's your primary residence and you've lived in it at least 2 years, um, you get a tax-free, so 250,000 per person. So if it's a single, you get 250,000. If it's married, filing jointly, you get 500,000. So the gain from that, that's how much you get gain free. So, uh, most of the time, I'm not seeing people pay taxes on their residence, so capital gains tax on a re personal residence because of that. We're getting that tax free. Um, and yeah, if the home or the property was a rental property, you would pay capital gains tax on it. There's no deduction from that. So I am not, um, yeah, you don't, it's not switching one home for another, right? It's you get a tax-free 250,000 per person up to, 500 if you're 500,000 if you're filing married, filing jointly. Um, and that's what you get. And this is the gain, right? So if you paid $250,000 for a home, married filing jointly, and however many years later you sell it for 750,000, that's $500,000 of gain. Okay, we're not even here. I'm not even factoring in, right? There's expenses, right? When you go to sell a home, you can take those off. So in that case, that person would not be paying any taxes on that home and that sale of that home. Does that make sense? I hope so. But you also you get to add in any updates. So if you put in a new HVAC, if you put on a new roof, if you did major renovations, right? New flooring, new carpeting, all of those things count and they're going to add to that 250,000. So now maybe you're at 300,000 with all those updates. Maybe you're at 350. Maybe you did a lot of work for the home. Um, so again, you're not going to pay any tax on that home. I hope that makes sense. I will stick around. If anyone has any further questions, feel free to leave them in the chat. Otherwise, like I said, it's thick of tax season. So I'm going to jump off and I'm going to get back to doing my tax returns for my clients. I really appreciate everyone joining me today. And I hope you guys got something out of it. And if you have more questions, please feel free to submit them. Here, I'll just share that link one more time. Um, for the next Text Tuesday, again, I always go through the questions that were submitted ahead of time first. And the next one happens to be April 1st. That's the Tuesday. It's the first Tuesday of April, is April 1st. So we'll see you April 1st, 10 a.m. Mountain Time. You're welcome. Thank you for joining me here and attending live. I really appreciate it. And I wish everyone have a great March wherever you happen to be. And I'll see you in April.